Hi everybody, good afternoon. My name is Di Gresham. I'm the coordinator of the Young Dairy Network Australia. Welcome to today's Preparing to Meet the Bank webinar. This has been developed together with the Farm Business Management team at Dairy Australia to provide support to young people in dairy with tips on how to best approach a financial institution as you prepare to seek finance for your dairy business. Today we are joined by Farm Business Management consultant Fiona Smith. Fiona lives in southwest Victoria and is also an ex-banker, so she has experience across all aspects of this process. We also have with us Ian Linley with Fiona today. Ian is our Farm Business Management with our Farm Business Management team at Dairy Australia. So welcome Fiona and Ian.
Hi, thanks Di.
Throughout today's webinar, you will have opportunities to ask questions of Fiona. Please type them into the chat box on the bottom left-hand corner of your screen you can see there, or if you're having any issues, also please type them into that box and we'll endeavour to answer them as we go along. We're also recording this webinar, and once it's finished, the link will be emailed to all our registered participants, and we'll also make it available via our YDNA Facebook page and the Dairy Australia website. So in addition to what we're presenting today, Dairy Australia conducts a range of farm business management training and workshop programs for the dairy industry throughout all our dairy regions. There are training programs from the farm business fundamentals level right through to the more advanced farm business analysis. Governance programs are also available, and these all generally run for 2 to 3 days. So I'm now going to hand you all over to Fiona, who can talk to you about meeting with the bank. Thanks, Fiona.
Thanks, Di. Hi, everyone. We're going to run through, I think you'll all have the agenda sitting in front of you. We're going to run through a few things today, starting off with the banking partnership, which we do classify as being very much a partnership, running through the types of finance, the key documents that you'll need when you're looking to meet with the bank. We have got a farmer video today from some share farmers down based in southwest Victoria, so feedback from them on the relationship they've got with the bank and how they've approached that. We'll then cover off what we call the 3 Cs, which are critical to any discussion that you're having with the bank, and talk about what we call the risk profile and customer margins that you have. And then we will also cover off at the end in a little bit more detail the FBM farm business management tools that we've got available. So Di sort of touched then on some of the additional courses that are available, but we'll also talk about some of the actual additional tools that you can access through the Dairy Australia website. As Di said, please feel free to type in any specific questions you've got. We'll look to actually address them as we work through the webinar, so I'll try and sort of look at them as we go, but the other option is that we'll come to them at the end if they don't sort of slot into the discussion that we're having at that time. So for anyone who's, I suppose, dealt with banks or looking to deal with banks in the future, which I suppose unfortunately or fortunately in this day and age you can't really do a lot in business without having some form of relationship with your bank. Unless you've won lotto, you're generally needing to speak to your bank about getting finance of some sort for the farming enterprise. So we need to make sure we're viewing that as a partnership. We're talking about service providers that help dairy farmers in the industry. Bankers really are one of the key ones that you need to develop a partnership with. The downside to developing a partnership with your banker is that they do tend to move around a little bit. One piece of advice I would give to people when they're seeking out a bank and starting that relationship is make sure you have that relationship with the banker and also their offsider. So a lot of the, I suppose, agribusiness managers that you have in banks actually have, I suppose, customer relations managers that sit with them or assistants that are helping, and I think it's always good to also have a relationship with them. At the end of the day, they do also do some of the legwork in the back end, and they're often people that tend to stay consistently with the bank in one area, so it might actually be them that's conveying the information to your new bank manager that comes on board. I think when you're meeting with your bank, you need to make sure that both of you understand where you're looking to head with your dairy business and what your short-term goals and your long-term goals are. So particularly for young farmers coming into the industry, you've sort of got a growth plan in mind about coming up through, possibly through share farming and then leasing and then farm ownership. And it's best to start that communication early with your bank so that they're aware that that's the goal that you're looking to achieve. There's not a lot of point you sort of having a business plan about the fact that you've got a 10-year plan to get to a certain place and not having a bank on board with what you're wanting to do. Preference is to have that relationship from the start and make sure you carry it through. So part of that is actually about understanding your own needs, and that if there's, I suppose, 2 people involved in the business, or if there are more, sometimes there might be multiple family members, or it might be a husband and wife or partners. It's best if you're all on the same page and you've got aligned goals that you're looking to achieve for that business, that you can actually speak to the bank about those. And make sure you're outlining all of that to the bank when you go and have all those initial meetings with them. Now, generally speaking, when we're talking about the types of finance you can get through banks, we talk about what we call working capital or overdraft facilities. Some banks actually have this combined in an all-in-one account, which actually has a working capital portion and a long-term portion to it, which some of you might be aware of. Generally speaking, that working capital overdraft loan is for managing cash flow. It's really handy at the start of your career, in that you need to have that in place so that you can actually start out with what you're wanting to do. But it's also really critical particularly in hard times, when things like milk price drops or we have a poor start to the season and you're actually having to purchase more fodder than you're expecting. That's when the working capital side of things becomes really important. And I think the key to being able to really manage your cash flow and know exactly what's going on with your working capital and overdraft is actually having a cash flow. It's wonderful to have an annual cash flow because you need to have some projection of where you're heading with your business, but preferably you need that to be a monthly cash flow because, as I'm sure a lot of you would be aware, there's often a difference between your peak income periods where cows are peaking and you're getting all your money versus those times where you've actually got your peak expenses, and often those income and expenses lines, if you drew them on a graph throughout the year, don't match. And a monthly cash flow will give you that cumulative position with your business so that you actually know where you're going to be short on cash, and gives you the ability to go to the bank early and say, look, we can foresee that in, might be in April next year, we're going to have cash flow problems, and actually start that conversation really early with the bank. It's part of just having a really proactive relationship, and banks certainly appreciate knowing in advance if that sort of situation is going to arise. Equipment finance and livestock loans for things like, any pieces of plant and equipment, motorbikes, tractors, any of that sort of stuff, and then livestock loans. They tend to be short-term, so they tend to be against what they classify as the life of that piece of equipment. Generally a 3 to 5 year period tends to be. Irrigation equipment can sometimes be longer. So they're a wonderful thing in that they're secured against the actual piece of equipment, if that's what you're doing. So that's one benefit in terms of if your equity is a bit tight, banks will actually take security against the equipment. The shortfall, I suppose, on equipment finance and livestock loans is that they're a big draw on cash flow because you're having to cover principal and interest over a short period of time. So just have to keep in mind when you're doing cash flow budgets, if you're putting in a new piece of equipment, that you'll actually want to make sure you've factored that into the cash flow. So I will just, I'll cover off about long-term loans, then I'll come back to a question that's actually come in. So long-term loans, when you're using land and water assets as the actual security, and it gives the bank the ability to do a longer-term loan, tends to be, for agricultural loans, tends to be over a 15-year term, with the exception that if you're using a residential house, then you may get a longer term on that finance. So long-term loans, you get the benefit of having a longer period of time. You also get the benefit that you can have them as an interest-only setup, although keep in mind that some of the flexibility that banks have had around interest-only are probably going to change a little bit on the back of this Royal Commission. So I think the ease with which people have got interest-only loans may change a little bit in the future. I'll just come back to Ian's put in a question about whether it's feasible to get the bank involved in developing a business plan. I think they're a key service provider to get on board, because you need, really, if you're going to need finance to achieve that business plan and achieve your goals, then the best option is actually to get buy-in from your bank. Just the only thing I would say is be wary in that there is also guidance that's probably going to come out as a result of some of this Royal Commission stuff about how much directive is coming from the banks on how active their role can be in developing a business plan or a cash flow, because there's been some feedback that there's situations where the bank have essentially just created their own cash flow or business plan for business, and there hasn't necessarily been buy-in from the business owner. So it's very good to get them involved, but just keep in mind that they may be a little bit cautious about being very active in that process. So they're the types of finance. Now, when you're going to a bank, and you'll actually, when we come to the video in a little bit from the share farmers, there's some additional information that they've actually said they needed when they went to a bank, and I'll come to that in a minute. But this idea of 3 years of financial statements from your accountant is wonderful if you've been in dairy farming for 3 years, because you can go to the bank with your 3 years of financial statements. If you're starting out, that's obviously not possible. In which case banks will obviously be really keen to look at cash flow projections and budgets, but they will also consider, you know, what you've been doing prior to that. Have you been working on farms? Have you been earning a wage? What have you been doing? But we realise that that can be the downside of going to a bank initially, is that, you know, one of their key criteria is to preferably have those financial statements, and that can be difficult to provide if you're starting out. Key thing when you're providing financial statements to your accountant. So financial statements are prepared by your accountant for the purpose of reporting of tax position to the tax office. So there's a few things to keep in mind. The income and expenses for those financial statements won't necessarily align to the production year, so the bank needs to be aware of that. They need to know exactly what the milk income was that matched the production year, and the same thing with expenses. So if you've had expenses in there, let's just say you've had a really phenomenal year, you might all be laughing about that, but yeah, the years that you do have phenomenal years, you might have actually gone out and prepaid for things like feed and fertiliser. You need to let your accountant know if that's sitting in the expenses for that particular financial year, because if you don't, they get to the end position for that financial year and think, oh, cash flow wasn't as strong as they would have expected, but actually it might have just been that you paid, you know, 40,000 in prepaid fertiliser for the coming year, or you might have had, you know, hay that turned up with worth 30,000 that you didn't use for that year. So when we talk about adjusted financial statements, this is where you need to have a conversation with your bank to say, this is my profit and loss for tax purposes, but these are some of the adjustments you need to make. Another classic example is things like repairs and maintenance. So I don't know whether I should say good accountants. Accountants who are trying to reduce your tax position will often put what we classify as capital items in repairs and maintenance. So things like you might have spent 50,000 on new laneways, and whilst that is a genuine repairs and maintenance item for that year, it's not something that the bank would put in just in one financial year, because you've actually got the benefit of that over an extended period of time. So just keep in mind that the bank doesn't know that information without you telling them. So it's about having an open conversation about, here's our information, but these are the changes that need to be made. Milk statements are a key one. Part of that is actually about aligning that milk income back with the production year, because often your accounts won't actually have them lined up. Statement of assets and liabilities, once again, the financial statements are helpful They're certainly really good for the liabilities position because it gives the debt, the bank can look and see what the debt position is. The issue with assets out of your accounts are that they're done at a written down value. So when we talk about providing a statement of position to the bank, it's based on the market value of any assets that you've got available to you. And they also look at the overall assets for you as an individual, so not just for the farm. So you've just got to keep in mind that they'll want all of that information and they'll want it based on a realistic market value for those assets. Bank statements for the past 12 months, so that's just key in banks. Obviously, if you're changing banks, if you're staying with the same bank or approaching a bank you're already with, they've got access to that information. It's more if you're looking to shop around to other banks, they'll actually want that information from your current bank. Business plan, they would want that as a business plan, as opposed to just one that you've sort of got verbally between yourself and business partners. The income estimation from your processor, so moving for the year moving forward, and with that combined with a budget. So budgets are key when you're going for any new finance, essentially, but they become really key if you're starting out. So particularly for young farmers who are wanting to get into the industry, either under share farming or lease agreements. Obviously, those budgets to start with are really key, and then if you're planning on making any big changes in the business, so if you're looking at changing things like stocking rate or buying extra land, then that's where the budgets become really critical because they can't look back at your historical information and make an assessment about what's happening in your business. And the final one in this list is a farm business analysis, which the banks actually are moving, they're actually placing a fair bit of weight in a farm business analysis. So for anyone who doesn't understand that term, it's essentially combining all the physical information for your dairy farm with the financial information and giving a set of management reports. So it just gives a more holistic view of your business and gives them the ability to actually assess, the strengths in your business, the areas that you can improve, and actually make an assessment about what's happening with the combined information from the physical and the financial. And when we move into the video from Todd and Maddie, you'll see that there are some additional things that are required, particularly for young farmers that are coming into the industry. So if you're under a share farm agreement, they generally want to see that actual written share farm agreement to know that it's, one, that there is a formal agreement and also to know how long it's likely to go for. And then if you're leasing land, they often want to see that lease agreement. So the reason for that is that they're essentially the guarantee that you're going to have some form of income coming in over that period of time, because obviously if you don't have a share farm agreement or a lease agreement, whoever you're in that relationship with could pull out tomorrow and then all of a sudden the bank don't have any form of income to actually cover their debt. So they'll look for a share farm agreement and a lease agreement, and when you're then offering livestock as security, they'll want information about their NLIS, so the National Livestock Identification System. They'll need details of that for livestock, so they'll need a register of that as well. So before we move, I'll come back to some of that information further, but what we will actually do is go to the farmer video, which is Maddie and Todd Ledden. They're actually share farmers based down in Southwest Vic. They've been share farming for sort of 3.5, 4 years. They've had a growth phase over that time. They actually won the West Vic Share Farmer of the Year award for the last financial year, and they've just got some insight on the relationship that they have with their bank and how they approach the bank and some of the issues that they might have come across. So we'll just quickly watch that and then come back to the rest of the webinar.
My name is Todd Ledden, this is my wife Maddie, and we are share farmers at Toolong, and we borrowed money at the start of our career 3.5, 4 years ago now. It was mainly just to fund cows. Initially we started with nothing and needed to put a herd of cows together, so that initial call on the bank was to get money and capital to fund the cows.
I would say it's a little bit of both. Through the tough times, we got contacted by the bank to increase our overdraft and things like that, but otherwise we contact them when we sort of need to borrow money or review rates or anything like that.
I'd say when there's, we don't speak to them that often, but there is cases when we want to review what we're doing and look at our current loans and whatnot. But I'd say every
12 months, I think.
Yeah,
might hear from them maybe a little bit more if there's something sort of happening, but at least every 12 months.
I think at the start we did try with other banks and spoke to other banks about getting the initial money, and it was a tricky one because we had no backing or not a great deal of equity behind us. So it was a little bit difficult at the starting point, yes.
We prepare our own cash flow. We did do the help from Dairy Australia. Hugh Crockford came out and had a bit of a look at our business, but every month we look at the milk check coming in and what bills we've got to pay out. Nothing's really strict though, and then sort of yearly we don't look at it too much. You've sort of got a bit of an idea on what's happening because we've been sort of doing it 3.5 years now, so we sort of got a bit of an idea on what's happening because it's similar to other years. You sort of sow and spread fertiliser at the same times every year. So, but mostly it's just the monthly one we sort of do right down to the dollar. We needed to get the NLIS list of all the cows that we had and just a list of our assets. At the time we had 60 Frisian heifers that were due to calve in the March, and this was in November, so we had to sort of just do a list of what we needed. We needed a cash flow, a share farm agreement, which we got off the Dairy Australia website, and just your normal applications as well.
So we spoke to one other bank prior to going to the bank where we are now, and other than that, we didn't speak to anyone else, did we?
No, not really. And we've got all of our loans with the one bank that we're with.
All right, thanks everyone. So, as you heard there from Maddie and Todd, they've obviously worked through that process from the start when they just had the rising twos coming into the herd and needed their NLIS register for that. They've obviously grown their herd over that period of time, so the relationship that they've had with the bank, I suppose, has changed a little bit in that they've had to work with the bank to try and make sure that they could actually purchase cows and move into a position where they were providing cash flow for the bank. It should be noted that Maddie does all the, I suppose, what you'll call the financial side of the business. She has a bit of a background in that, so she'd historically worked for, prior to having children, had worked for a financial planning group and had done a lot of work with financials. She tends to do that side of the business, and it's just another thing to be really aware of when you're, starting out in farm business and as you move through your career, is that you often have the two sides of your business. So you've got the person who's controlling the financial side of things, and then you've got the person who's doing the actual, I suppose, the operational activities on the farm. And it's just about making sure that you've got really key communication between those two people, because what's often happening in farming relationships is the person who's out there doing day-to-day stuff is making those decisions about buying feed, buying fertiliser, and doing that for all the right reasons, in that they're doing it for the purpose of, getting production out of cows and making sure they've got pasture available when they need it. the downside to it is that they're not always communicating with the person who's controlling the financial side of the business. So even if you have a monthly cash flow, you often have the person who does the financial side of things who's monitoring that cash flow on a relatively regular basis, and then all of a sudden 2 extra loads of hay appear and they didn't have it in their cash flow and they don't necessarily have the money for it. So it's about making sure that first and foremost the communication between the actual operational and financial person within the business is right, and then making sure that that communication is then conveyed back to the bank. Things that banks don't like are last-minute requests for things like temporary overdrafts, when in fact it would have been better if that they realise that there are circumstances where that's required. When things go horribly wrong, or you suddenly need to buy more feed, or you get salmonella in the herd, or something like that. But it's different if there were things that they could have actually planned for and projected for. So I think the video from Todd and Maddie just gives us a really good snapshot of how some young people have approached it. I think it is worth noting that when you're trying to get into the dairy industry, it can be problematic trying to get finance for things like animals. Up until relatively recently, the banks were actually, it was hard to get any finance out of them on the livestock unless you also had landed security, which the majority of people that were looking to come out and do share farming, unless they had some sort of, family backing either on land or residential property, was very problematic. So until the banks moved to a position where they would actually lend against the livestock, that was actually quite problematic. So we now come to what we call the 3 C's when we're talking about approaching banking. We actually say that that's more a 4 C's project, but I'll come to that bit at the end. There's sort of this overarching concept that communication has to sit, I suppose, as a higher C above all these, because without communication within your business and with your bank, the relationship actually doesn't work that well, and it makes it really problematic when you're actually trying to work with the bank and get additional finance. So the more you communicate with your bank about what you're planning to do in the long term and about what you're doing in the short term, the better that relationship will be. So when banks, when they assess loans and work out whether they actually want you as a client first and foremost, and then the actual finance that they can provide you, these are sort of the three things that they're considering. So the first is the cash flow. So basically, do you have the ability to cover interest, firstly? And then do you actually have the ability to repay that loan? So I think whilst there has been this long-held belief that banks are happy going interest only because basically they just keep getting money out of you, that will shift. So the process of assessing loans is going to move towards a position that actually you do need to show that you can pay it off in a certain period of time, because I think there's going to be a change in policy around that side of things. So they'll assess your historical performance, where there is historical performance, and look at that with any cash flow projections that you've got moving forward. For people who are looking to come out into a share farming or a lease position, this is where people, I suppose, they get a little bit turned off because it's quite hard to get a cash flow projection if you haven't already been doing it. So part of it is if you've got a really good relationship with the farm owner, whose farm that you're going on to and setting up a share farm agreement, they will sometimes actually be willing to provide their financial information for the last couple of years so that the bank can actually say, okay, this is how the farm's performed. Whilst there might be some changes to that, they can at least get a picture about the sustainability of that business moving forward. And alternatively, you need to actually look at, achieving cash flow projections that are realistic for the region where you're going to be farming and for the system that you're going to be farming in. And that's probably where you need to get some service providers involved. You can get an income estimate from your milk company, but in terms of the cost side of things, that's probably where you need to start looking at what other people are doing in that region and getting a cash flow projection on that basis. So they look at the cash flow, make sure you can actually repay the debt. They'll look at collateral, or otherwise known as security. Banks often refer to it as security as well, which is about sort of the cash flow is the first way of getting out, the easy way for them to clear their debt position, and then collateral is the next, which is if things really start to hit the fan, they've got the ability to come back and get this security so that they can repay loans. Generally, they look at things like land and livestock and equipment, and obviously as you move further into the industry, it's easier to get some of those, I suppose, that security. Things like land can be problematic when you're first starting out because often you've only got livestock and equipment. But they do also look at guarantors for that. That might be family members that are already on the land and they've got, you know, farm land that they can actually offer up as security, or it might be other guarantors in terms of banks did, other guarantors in terms of banks did for some period of time, I suppose, use parents as guarantors. Another thing that will come out of this Royal Commission is that that will be, have been slowly moving away from it, but that will almost stop, I think. So they've essentially said that residential properties for parents won't be touched, because obviously that's the last thing they want to do is sell up your parents' house to try and recoup your debt. So they'll essentially move away from that, and they will start to query even further if it's other security being offered by parents. So just keep in mind that some of that might become a little bit more problematic moving into the future. But the benefit is that you can actually now get loans against your livestock. So obviously for anyone coming into share farming, then that's really beneficial. And then they look at character, which is essentially, are you reliable and are you trustworthy, which you might think is hard for a bank to assess, particularly on a first meeting. You'd be surprised what banks can work out. One, from your credit history, so they can actually go back and do a full credit check, and that could be things like the fact that you haven't managed to pay your Telstra bill on a number of occasions, or your electricity bill, or things like that. And they will look at, if it's your first time out farming, they will actually look at things like management expertise. So have you managed a farm before? And I'm sure, as you would know, lots of agribusiness managers actually do stuff in the community, so it's not that hard for them to check the character. If you've been playing in the football club, or as some might, well, you might joke, some people might even look at your Facebook account to see how reliable you are. But I think they will have ways to check that if you haven't actually banked with them before. Part of that is credit history and looking at bank statements and things like that. So, and part of that character thing comes back to the cash flow budgets that you give them initially. So one way to really annoy a bank is to give them a cash flow projection that isn't even close to being realistic. So if you give them that in the first place, it actually puts that banker on the back foot straight away, and they're actually less likely to believe any future cash projections. So the best thing you can actually do is give a really realistic cash flow, with the preference that cash flows are actually, you complete what we call a sensitivity analysis on it. Banks will often do it anyway, but you need to be factoring in an impact of a drop in milk price, an increase in feed prices, or an increase in fertiliser prices. So there are just some things that you can do within that cash flow to show your bank that you're really thinking about what could actually happen within the business and how you're going to manage that risk position. So a lot of it is actually about saying, okay, here's my cash flow, but if milk price drops to this position, then I'm still in a position that I can cover my interest. I might be short on principal repayments for a period of time, but I can cover the interest. So it's about showing them that you've assessed the risks to your business and showing them some of the mitigating factors to actually get around that position. So you don't want to put up a cash flow projection that's all, you know, looking through things with rose-coloured glasses, and then needing to go back to the bank in 6 months' time and ask for additional finance. So, and the overarching principle above that is this whole thing of communication. So make sure you continue to communicate with your bank. The level of communication will depend on where you're at in your business. So when you get to a steady state, you will communicate with them less frequently. But when you're in a growth phase, you'll probably find that you'll be speaking to them a lot. And if you have issues with milk price or feed prices or season, then you'll find that you might need to be speaking to them more frequently. So we now move into the, I suppose, what we call the security options when you're looking at loans. So the banks will all they tend to be relatively consistent in what they lend against particular options of security, but there can be a little bit of variation in that. Things like cash and term deposit, which some people laugh about because you don't often have a lot of cash and term deposit money sitting about if you're about to go and borrow money, but they will tend to lend 100% against that. Land tends to be 60 to 70%. That can vary between bank, and it can also vary depending on the type of land. So residential, they'll generally lend more. If you've got, let's say if you're getting into share farming but you've already got a house somewhere, then they will look at financing a certain amount against that. Livestock, when they look at livestock, it is productive only, so ones that are going to make milk, and they generally look at a 40 to 50%. But that's on a standard value. So it's not based on what you think your cows are worth. So let's just say you've got a stud herd and you think they're worth 2,500 to 3,000 a cow. The banks will actually have essentially an upper end on what they will value those animals at, and then they do 40 to 50% against what they have as their standard value. Plant and equipment, if you're doing an actual equipment finance loan, it's generally 100%, so they generally give you the full amount. But if you're looking to get finance against, let's just say a tractor or something that you've had for a period of time, they will still lend against that equipment. It's just that they actually lend a lower value against it. So you just need to keep that in mind depending on what you're doing. The other thing, as a bit of an aside, is when you're looking at equipment finance loans, one option is banks. One option are the actual dealers that you're getting the equipment finance from. So if you're looking to purchase something like a tractor, you might actually go to you'll often find that the dealers will have subsidised finance options. They're a really good thing to consider. They sometimes have really good deals that can actually be a better position for you for your cash flow. Just keep in mind that when you go through that process, you need to factor in all the interest information that they give you, because they'll often have like a base rate and a margin, but also the fees. You will sometimes find that when you go to a dealership, once you actually add up all the interest and fees and things that they're charging you, you might actually find the bank cheaper. Or alternatively, you might find that when you add up all of that for the bank, you find the dealers cheaper. So just make sure when you're doing any comparison that you're adding up all the interest rate and fees for the loans that you're doing. So just got to keep that in mind. And then we'll come down to this, what we call a risk profile or customer margin. I think there are a number of people that aren't aware that banks put a customer margin on top of, so they essentially have a base rate on loans, and then there's this margin that goes on top, which is based on, it's essentially assessed on those 3 C's that we've discussed, and they give you what's called a risk profile, and the different banks have different ways of grading that. So they want to look at things like your equity position, the cash that you've got available for debt servicing, and so the ability to cover both the interest and principal payments on those loans. But when they're doing it, they also need to know with cash, when they're looking at your cash flow position, the actual drawings that you've got in your business. And this is a really key one when banks look at things. They'll ask you what your drawings are. Your profit and loss statements from your accountant, once again, aren't overly beneficial for that because there can be lots of things that sit in your drawings. But you need to give them a really realistic figure. So if you legitimately do have, a holiday plan for that year, or you're planning on doing something, you need to actually tell them what your drawings are, because there's no point going to the bank and the bank saying, okay, you can afford a loan of this amount, and it actually doesn't give you enough to live on. So everyone believes that you can, tighten the purse strings when you need to, but you need to be realistic about the drawings figure that you're going to need, and that will be dependent on, your situation in life and your standard of living and the number of children you have and what stage of life your children are at. So I'm sure you can have arguments with lots of people about whether babies or uni students are more expensive, but they're just things that need to be factored in when you're dealing with your bank, because you need to make sure you've got enough to live on. So what they do is they do this risk profile, assess your business to see how it has been travelling and how it looks like it's going to travel in the future, and then they add a margin on top of the base rate. So obviously the better you are in terms of the higher the equity, the better your cash flow position, and I suppose the more sustainable you've been over a long period of time in showing the bank that you can repay debt when you said you were going to, the better that risk profile and the lower the customer margin you're going to get. They're subject to review, so banks can actually review this whenever they want. They can increase it and they can decrease it. So just be wary that if you have a tough year, make sure you're on the front foot about having that conversation with the bank about, what caused you to have a tough year, why was cash flow down, so that there isn't, I suppose, so that they haven't already decided that they're going to do a review and increase your margin. And you also need to keep in mind that often the final decision about things like customer margins and whether or not your loan actually gets financed is not necessarily decided by the actual banker that you're dealing with. So you may have a great relationship with your banker and you have a great time, chatting to him down at the football club, but you have to keep in mind that there's often a credit manager that sits above that person who's actually making the assessment. So the more information you give them and the more proof that you can provide to the bank on cash flows and historical information, the easier it is for them to actually go back to a credit manager and say, okay, this is the overall position, this is why I think it's okay, and the more likely it is that you'll, one, get the loan, and two, that you'll have a lower risk profile. So you need to know what that risk profile is. Lots of people aren't necessarily even aware that it's there, and most people probably don't actually know what their risk profile and customer margin is with the bank. So ask them. They'll tell you what it is, and have a conversation with them about, okay, what do we need to improve that position? Sometimes that can actually just be time. So it just might be that you've only been banking with them for 2 years, you've only been share farming for 2 years, and they need a few more runs on the ball before they're willing to review it. So some of it might just be a timing thing, in that you need to have a few more runs under your belt. But in other situations, it is actually about saying, okay, well, what can we do to improve our position to make sure we're paying the lowest margin that we possibly can? So Di talked earlier about some of the courses that Dairy Australia have got available, and part of that, the banking is a portion of it, but part of it is actually about having these fundamentals and farm analysis courses that will actually, the idea is to have farmers better positioned to have these discussions with their bankers and with other service providers and understand their businesses better. So some of the tools that are available are the Standard Chart of Accounts, which is essentially underpinning all the farm business management initiatives that we've got running at the moment. It's actually also key when you're running your own business to have the information aligned with other people in the industry, because if you want to be able to have conversations not only with your banker but with other farmers or with other service providers, the idea is that we're trying to have a really consistent approach to terminology, even down at this base level of things like income and expenses. And it's about starting to have that conversation with your accountant, so that when we are making comparisons within your own business and to other businesses, because the banks do that, they do actually make comparisons between dairy farms within their portfolios, they can actually compare apples with apples. So it's about making sure that the income and expense items are actually all aligned. So there's the Standard Chart of Accounts that if you're starting out or if you're wanting to start in a new financial year, you can actually we're looking to have it so you can actually upload it into an accounting program. So that's sort of the base document for just a knowledge. And then there is actually this dairy cash budgeting tool. So we've actually got a monthly cash flow where you can put in the opening position of your overdraft, and it will actually run through as you do your income and expenses over that 12-month period. It will actually give you the peaks and troughs on that cash flow. So it'll actually say to you, okay, you're going to be in overdraft here, or you're going to be sitting in credit in these particular months and have available cash. So there's some really key tools that you can get off the website. They're relatively, they're straightforward to follow through. The Chart of Accounts has actually got an explanatory guide with it, which has got all the information. And the cash flow tool flows through from that, so the income and expenses actually align. And banks essentially are working on they're working on the assumption and they actually want to see a monthly cash flow budget so that they can see all of this. They'll do their own budgeting, so they do their own budgeting based on what they classify as a year in, year out milk price or the average milk price for your farm, but they'll generally do it off the back of the information that you're actually providing to them. So there's some of the tools that are available. You can actually get them through the website, and it's just key information to have when you're actually preparing to go and have these discussions with your banks. Now, I might actually even hand over to Ian quickly now, just to briefly cover off, I suppose, the role of the RDPs and, actually Di is going to cover off the role of the RDPs and essentially them being the first point of call when we're discussing a lot of this business management stuff. So over to you, Di.
Thanks, Fee. I'm just going to go back quickly, if you don't mind. I just wanted to draw everyone's attention to where to get these tools from the DairyBase website, which is dairybase.com.au. It's a standalone website that can provide you with all this information. So thanks, Fee. If from today, if after today's webinar you are interested in more information about meeting with the bank, there's also a meeting with the bank workshop available. It runs over a day and a half. And if you're interested in finding out what's happening in your region, you can contact your regional development programs or your RDP. So they're covered off across all of our dairying regions. They're all around our country. And we have 3 standalone in Victoria with Murray Dairy, Wessex Dairy and Gipps Dairy. Give them a call and they can let you know what activities are planned, or indeed you can actually ask them that you'd really like to see a meeting with your bank workshop happen in your region, and they might be able to organise one for you. So when you're looking for contacts in Dairy Australia, the best place to start is on the Dairy Australia website. Up here in the top corner, there's a link that will take you to the regions and locations. Choose your location, and all of the contacts for your extension coordinators and for the regional development programs are listed there. So very quickly, have there been any other questions that have come up today? Fee, I just had a quick one, if you don't mind, when you were talking about customer margins. Yes. How variable can they be? And, you know, is that usually sitting around the 1 or 2%, or can they be even higher than that in that interest rate?
Look, it does depend a little bit on banks. I've actually seen some quite low customer margins. You tend not to see, so agricultural margins tend to be higher than if you've got things like commercial property or residential property sitting as security. So farming ones, probably you can get some that sit. You don't get many down at the 0.5% mark, but you get some at the 75 basis points above, so 0.75%. And they go, generally speaking, if you're getting up, I would say if you're getting up to that 2.5%, 3% margin, then you're in a position that the bank's monitoring you pretty closely. So you're probably on a pretty regular review basis to make sure that you're actually meeting your commitments. So, but yeah, there is a fair bit of variation, and I must admit that there's been a number of circumstances where people have decided to shop around with banks, and in the process of doing that, they've actually had their own bank come back and say that they can reduce their margin. So whilst it's wonderful to have a relationship, and it's all about having a relationship with your bank, also don't be scared to sometimes have conversations with other banks, and it may mean that you get some review of your margin with your existing bank. So I think just keep that in mind, because you do sometimes get some benefit out of shopping around.
Yeah, and all things being equal, that would be a key reason to shop around, wouldn't it? To make all the difference at the end of the day or the end of the year in terms of what interest rate you're actually paying.
That's right.
Okay, so Ian has just clarified for us that the banking workshop, depending on where it's run and how it's run, it actually goes for 2 to 4 hours rather than a full day. So thank you very much, Ian. Okay, with that being said, Ian, is there anything else that you'd like to add to today's webinar and our discussion that we've been having?
Not from my point of view, I don't think, unless people have got other questions.
Not from me, Di, but thanks for participating and go unravel the cages of your region for any farm business management training that exists or that you'd like to see.
Okay, with that said, well, thank you again, everybody, for being a part of today's webinar, and thank you to Ian and Fiona for being part of developing this program. It's been there's a lot of information in a very short space of time, and so we really appreciate that, Fiona. Thank you.
My pleasure.
Everybody keep an eye out for the link that we will make available of this recorded webinar. We will put it both on the YDNA Facebook page and also on the Dairy Australia website. For other information about what's happening with the YDNA opportunities events, keep an eye on our Facebook page or touch base with your local YDN coordinators across the regions. And as Ian said, farm business management is a big part of what we deliver to dairy farmers across the Dairy Australia family, and there's always something that might suit you. So that actually brings us to a close. We're a few minutes early, so if there is another burning question out there, we'd be very happy to take it. Maybe one coming in. If not, then we will collate all this information and actually put it together with the webinar and make it available to you. So thank you, everybody. We look forward to seeing you in your region soon.
Thanks, Di.
Thanks, Di.
No problem. Thank you.